Okay, our next method is going to be the high-low method. When we're looking at the high-low method, it's a way to estimate the cost equation with 2 points, the highest and the lowest volume levels. So the high-low method uses the following steps. We're going to be able to compute the variable cost per unit and the total fixed cost from this. So we first have to be able to identify the highest and the lowest volume levels. It's important to note that these might not be the highest or lowest levels of cost. We're looking for a volume, so highest volume, lowest volume. So in this example, units produced. We're going to compute the slope, the variable cost per unit, using the high and the low activity levels. And then we can compute the total fixed cost by computing the variable cost at either the high or the low point, and then subtracting that amount to figure out the fixed cost by using that total cost from the activity level. So let's look at an example for this one. So the high-low method, it gives us the high level, the high volume level for November was 67,500 units with a total cost of 31,000. The low volume level was in June with 17,500 units, had a cost of 18,500. So we're going to be looking at the change in cost and the change in units. So that's how we're getting our slope. So the change in cost is 31,000 minus 18,500. That gives us 12,500. Then we have the change in units, 67,500 minus 17,500. So we get 50,000. If we multiply or we divide that out, 12,500 divided by 50,000, we get 25 cents per unit. That is our variable cost per unit. Then we can take one of our points and we're going to be able to plug that in there into our equation. So we see our equation is total cost equals fixed cost plus the variable cost per unit times the number of units. So we know our total cost for the point we chose, November, is 31,000. Our variable cost per unit is 25 cents per unit, and in November we had 67,500 units. So that if we multiply the variable cost per unit times the number of units, we get 16,875. We're trying to solve for the fixed cost. So if we solve using algebra, our fixed cost is 14,125. So our formula is total cost equals 14,125 plus 25 cents per unit produced. So that's how we would compute it with a high-low method. The weakness of the high-low method is that it ignores all cost points except for the highest and the lowest volume levels though. Alright, let's talk about the regression, the least squares regression. So it's a statistical method that's identifying a cost behavior. For our purposes, we're going to use the cost equation estimated for this method, but leave the computational part for a different course, which would be intermediate. So when we're looking at this, we're going to be able to just recognize there is another method and that it's a statistical calculation. The objective of this analysis is the same. We want to determine that total fixed cost and the variable unit cost. And that's as far as we're going to take that one. Alright, when we're comparing the cost estimation methods, we're looking at the high-low. We have a fixed cost of 14,125, variable cost per unit of 25 cents per unit. The example they gave here, regression, gives us a fixed cost of 16,688 and 20 cents per unit. Our scatter diagram had a fixed cost of 17,000. So we can kind of just compare them to see where we're at. Alright, last part. Sorry, that's not true. Next part, we're looking at the contribution margin areas. So contribution margin, we are looking at, we have contribution margin per unit, which is the selling price per unit minus the total variable cost per unit. So when we're looking at this, when we're looking at CVP analysis, it's going to require our managers to classify costs as either fixed or variable with respect to the volume of the activity. When it's a manufacturing company, the volume of activity typically is referring to how much we're producing. So then we can classify a cost as either fixed or variable depending on whether total cost changes as the number of units produced changes. Once we classify the cost behavior, we can then compute a product's contribution margin. So the contribution margin per unit, or the unit contribution margin, is the amount that a product's unit selling price exceeds its total variable cost per unit. So this amount contributes to covering fixed costs and generating our profits, which is what we want to see. So the top part here shows the formula used to calculate contribution margin per unit, selling price per unit minus total variable cost per unit. Another way we can calculate contribution margin is as a ratio. So the contribution margin ratio, which is the percent of a unit's selling price that exceeds the total unit variable cost, is useful for business decisions also. It can be interpreted as a percent of each sales dollar that remains after deducting the total unit variable cost. So the second graphic here shows the formula for that, contribution margin per unit divided by the selling price per unit. So to give an example, let's consider Rydell. It sells footballs for $100 each. It has variable costs of $70 per football that's sold. It has fixed cost of $24,000 per month with a monthly capacity of 1,800 units. Their contribution margin per unit is $30, which we can see 100 minus 70 gives us a contribution margin per unit of $30. That's going to go toward that fixed cost, and then anything over that's going to give us our profit. So if they're selling at a price of $100 per unit, they cover their variable costs and they make $30 per football to contribute to that fixed cost and profit. If we look at their contribution margin ratio, it's 30%. That 30 contribution margin per unit divided by the selling price per unit, $100. So it's 30%. A contribution margin ratio of 30% says that for every dollar in sales, that company has 30 cents that contributes to fixed cost and profit. All right, let's look next at break even. So using break even analysis, the break even point is the sales level where we don't make a profit or have a loss. We're just breaking even. So the concept applies to almost any organization, and it's a key point when you're launching a project to figure out, are you going to break even? And if so, when? How many years is it going to take you to break even? Will it be the first year? Is it going to take you 3 or 5 years? And that's what we want to be able to figure out, if our sales are going to at least cover the total cost. The break even point can be expressed in either units or in dollars of sales, and we'll look at those. So break even in units is our fixed cost divided by the contribution margin per unit that we just learned out how to figure out. And then we also have break even in dollars, which is fixed cost divided by the contribution margin ratio, which we also just calculated. So in the examples here, continuing that same example with the Rydell footballs, we have $100 per unit, $70 variable cost, fixed costs are $24,000. So we compute the break even point using the formula, and we see that fixed costs are $24,000 divided by the contribution margin per unit of $30. So for us to break even, we have to sell 800 units every month. When we look at dollars, we take our fixed costs, again that $24,000. This time we're dividing it by the contribution margin ratio of 30%. And it's going to tell us that we have to have $80,000 in sales to break even. So we can sell 80,000 units and break even. 80,000 sales in units, or we can sell 800 units. 800 times $100 per unit is our 80,000. So that's where we see that come from again. When we look at this, we can see what our contribution margin income statement looks like at break even. So we see that we have sales of 80,000 minus our variable cost of 56,000. 80 units is $70 each. gives us a contribution margin of $24,000. Our fixed costs are $24,000. So we would have 0 income, 0 loss, and we would break even, which is what we're trying to do. Okay, our next part starts looking at a CVP chart and graphs the costs and the sales that go along with it. So this is what a CVP chart looks like, and you can see that this one again is for that Rydell, that football, and it's their cost volume profit chart or their break-even chart, sometimes called a break-even graph, all the same thing. So the horizontal axis is the number of units produced and sold, and the vertical axis is the dollars of sales and costs. So the lines in the chart show both sales and costs at different output levels. So we have 3 things to do to prepare a CVP chart. First, we're going to plot our fixed costs on the vertical axis. Our fixed cost was $24,000. So that's the lowest it can be, and that's right here. We're going to draw a horizontal line at that level to show what fixed costs are going to be. They're going to remain the same. And then we would have a total line, a total cost line, which is this orange line here that shows our total cost. The lowest it could be is at $24,000, and then it's going to increase based on our quantity produced. We also see the green line, which is total sales, and again it starts at 0 because we could have 0 sales. The point where those 2 lines, that total sales and total cost, intersect, that is our break-even point. Anything above that in the blue is a profit. Anything below that in the pink would be a loss. All right, one last thing to talk about. With sometimes, just like we had break-even when we had changes in the estimates when it was depreciation, we can have changes in estimates here also when we're looking at CVP analysis, because it is using estimates. So it's important to know how those changes impact break-even. So a manager might form 3 estimates for each of the components of break-even. They might have an optimistic, a most likely, and then a pessimistic view. The ranges of break-even points in units can be computed using that break-even formula. So they give 3 examples here. If they had a selling price per unit of 105, their variable cost of 68, total fixed cost of 21. They go down to the next category. Most likely, we have a selling price per unit of 100, variable cost per unit of 70, and total fixed cost of 24. Our pessimistic, we have 95 as our selling price, 72 as our unit cost, and our total fixed costs are 27,000. So we could compute either of them using these numbers to be able to see. What this shows us is the revised break-even in units. So if they believe they can raise the selling price of a football to $105 without any change in unit variable or total fixed costs, then the revised contribution margin per football would be $35. $105 selling price minus the 70 variable cost per unit. And that gives you the revised break-in. We have that $35 on the bottom, so we take the $24,000 fixed cost divided by the $35, which is our revised contribution margin. And that's going to then give us how many units we have to sell to break even if we were to increase our sales price. So you can kind of play around with it and kind of see how those things are affected and what you have to do and how each component can have an effect on your overall numbers. So these graphs are going to show how changes in selling price, our variable costs, and our fixed costs impact our break-even. If the selling price can be increased without impacting variable costs or total fixed costs, then our break-even is going to decrease. If our competition reduces selling prices and the company cannot reduce our costs, the break-even is going to increase. Increases in either one, whether it's variable or fixed cost. If it can't be passed on to the customers by creating a higher selling price, then we could end up in a loss situation. But that's what we're trying to do, is pass that